All right, well, this is one of the changes in 2017 over 2016. Not that this reading is any different than it was in 2016, but it's moved from the derivative section to the fixed income section. It wasn't here last year. Doesn't really change anything, but I do think it flows a lot smoother because it comes right off of what we just did, credit analysis model. So I think the language helps us through this. So a credit default swap is, in essence, a derivative. It's a credit derivative. But the underlying, and this is really critical that you get this as soon as you can, the underlying is the borrower's credit quality. That creates a bit of a funny way of thinking about who's long and who's short here. It is the underlier's credit quality. So we are long. If you have a long position, you're betting on an improving credit quality. So if you're betting that the credit quality is going to improve, you would sell a CDS. You would sell a credit default swap. If you're short, you're short the underlying credit quality, you're making a bet that the credit quality of the issuer is going to decrease, you would buy a CDS. Now, when you buy a CDS, you're buying protection from a downgrade. You're buying protection from the credit quality of the issuer deteriorating. So by buying the CDS, you're inherently short the issuer's credit quality. If you think, you know what, for that issuer, their credit quality isn't going to deteriorate. Who wants protection? I'll protect anybody because I don't think it's going to deteriorate. By protecting people, you're willing to sell them that insurance policy that says, look, if it does deteriorate, I'll make good on it. But you don't think it is, which means you are inherently long. So this is confusing. The seller of a CDS is the long position because the underlying is the credit quality. The buyer of a CDS has a short position. That can be confusing. Let's just get that out of the way right now. All right. So what does a CDS do? It provides protection against default, number one, hence it's called a credit default swap, but also protects against changes in credit quality long before a default. So let's say that I hold a bond and I don't plan to hold it to maturity. It's a 10-year bond and I plan to hold it for the next couple of years before I'm ready to go back in the market. I put it into fixed income. But I want to protect myself from a downgrade or any kind of deterioration in credit quality. I'll buy a CDS against it to protect myself from any downside risk in that particular sense. So here's what it would look like. Let's say that I'm long a bond. I'll buy a CDS. By buying the CDS, I am short the credit quality, right? So let's say there's a credit downgrade. What happens to my two legs? Well, if I'm long a bond and there's a credit downgrade, the bond loses value. But because I bought a CDS which is short the credit quality, the CDS gains value because I gained from a short position when it actually deteriorates. So the credit downgrade worked in my favor on the short position, and my CDS gains value. So the value of a credit default swap will rise and fall with the changing likelihood of default. Now, here's the thing, if you're the seller of the CDS, actual default may never occur. So just because you sell CDS, you sell default insurance, the actual fluctuations in the credit quality of the issuer should not bother you too much simply because you're saying, look, yeah, sure, maybe it'll go up, maybe it'll go down, but I don't really lose. And I don't got to pay out unless there's an actual default. So you could sell this insurance on a bunch of companies. Those companies' credit quality could downgrade and decrease, but you don't have to leave your position. You could just say, I'm holding all the way to expiration simply because I don't think they'll default. Sure, their credit rating has been dropped, but I don't think they'll default. Now you're probably wondering, but if the other side wants out, don't you have to get out? Are these not OTC contracts? They are. They're OTC contracts, but we're going to see in a moment, well, maybe not a moment, a few moments, they're standardized. They become more standardized such that if one side wants to get out, they can simply open an offsetting position with a CDS dealer, and I can sit there as the seller and say, look, I'm holding all the way to the end because all of these fluctuations in credit quality don't bother me, only the default bothers me. So let's get a definition in here for a credit default swap. It is a derivative contract between two parties. Now, that part doesn't need to be said between two parties, simply because the very definition of a derivative contract is that it is between two parties. A credit protection buyer and a credit protection seller, in which the credit protection buyer makes a series of payments called premiums to the credit protection seller. Now we have the word swap. We have credit default, swap. The buyer is swapping a series of premiums in exchange for protection against default to the credit protection seller, and receives a promise of compensation for the credit losses resulting from default, which is a predefined credit event, and we'll look at what some of those are, of a third party. So think about it this way. Here's your protection buyer, here's your protection seller. The protection buyer makes periodic payments until default only, or until, if this is a 5-year credit default swap, for the life of the contract, or until default. If they open this up and 1 month later there's a default, the protection buyer doesn't have to make the payment anymore. So it makes these periodic payments to the protection seller. This is called the premium leg. We're going to see this word later on. Just make a note that, okay, that's the premium leg. The protection seller will make a payment if, there's your big word right there, if default. The premium leg, the periodic payments, these are determined and fixed at contract inception. And we're going to see that there really isn't much of a choice under standardized contracts. It used to be that they could be anything, not anymore. A single name CDS is a CDS on a specific borrower, referred to as the reference entity. And the contract specifies a reference obligation, a specific debt instrument, usually senior unsecured, so these are referred to as senior CDSs. This is important to note now. Any other debt of equal priority of claims or higher relative to the reference obligation is covered. Here's why, is because in corporations there's something called cross default. So while the obligation you're holding may not default, the issuer may default on something else, so that is covered. Not only that, when it comes to the settlement, what you get, okay, so there's a default. The other guy owes me money. I want to be paid now. Well, that settlement depends on what the other obligations are of the same priority are selling at that time. We're going to see more of that. Just be aware that's what it means. The payoff of a CDS is determined by the cheapest to deliver obligation. What does this mean? A company defaults, and let's say it has 4 different debt obligations, all with the same priority of claims. Well, one of them will be the cheapest of the 4. Whatever this one is, let's say that one is the cheapest of the 4 after the event. That's the cheapest of the 4. That sets up the payment in default for all of them. The payoff of a CDS is determined by the cheapest to deliver obligation. Must be the same seniority as the reference obligation on which you have your single name CDS on. All right, let's make sure we have that point down clear. So let's look at this green writing on the screen here. Assume that a company with several debt issues trading in the market files for bankruptcy. A credit event takes place. That's what it means. A credit event has taken place. What is the cheapest to deliver obligation for a senior CDS contract? And we have 3 choices. A subordinated unsecured bond trading at 20%, 5-year senior unsecured trading at 50%, and a 2-year senior unsecured trading at 45%. Which one do you think it would be? Well, you can't just look at what they're selling at for par. Remember now, it has to be of the same maturity level. So we can look at the subordinated unsecured and say, nope, we can't take that because it's saying a senior CDS. So we need a senior unsecured bond. This is a subordinated unsecured bond, so we can eliminate that. So we have 50% and 45%. Now, the 5-year and the 2-year might throw you off and say, well, how can we compare these things? Hey, listen, that's why we price bonds out on par, so that we can compare the cost of bonds across all different types of coupon, maturities, etc. There you go right there, 45% of par. Now, I'm going to write something down that you really need to understand here. The CDS holder, whoever is the holder, receives the payment based on the cheapest to deliver, even if they hold the 5-year bond. So let's say I bought the 5-year bond and I bought default insurance, a credit default swap on the 5-year bond. Even though the 2-year, these have equal priority of claim, even though this is a 2-year and I bought insurance on this bond, not this bond, because this bond is cheaper, that's what I would be paid out over here. Do you get that? Since this one is cheaper, I'd be paid out on it. Now, it turns out that that's okay with me. And here's why. Because what's the payout I'm going to get? If this is selling at 45% of par, I'll get 55% of par, but my bond is worth 50. So I'll get 55% of par and I can still sell this. So I make out pretty good. So the reason why we set it as the cheapest to deliver is that nobody does worse. They can only do better. So if I were holding the 2-year, if I were actually holding the cheapest to deliver, I could sell it for 45% of par and I'll be made good for the other 55. Anything above that is a bonus for the holder. So the holder will not be made worse by cheapest to deliver, either will be made whole or better by the cheapest to deliver. So we've covered single name CDS. Let's look at index CDS, and this is a credit default swap in a combination of borrowers, which introduces something called credit correlation. Now, we're not going to calculate this or figure out how it's calculated. We just need to be aware of what it is. Defaults by certain companies may be connected to defaults by other companies. The more correlated the defaults, the more costly it is to purchase protection. I think we can see that, right? We'll leave it to the credit derivative specialists to deal with that. You as an analyst just have to be aware that when we're looking at index CDS, if there is credit correlation among the components of the index, CDS will be more expensive to purchase. Now, that may set up a trading opportunity. If you think that the correlations are too low in an index CDS and that we're going into some difficult times, and you look at the components of the index and you say, you know what, there could be an issue here among all of them, that if there's a downgrade in one or two of these entities, that's going to spill over into a bunch of them. You might find a nice position in a CDS to buy a CDS and short the credit quality of the underlying within the index. All right, let's look at the CDS itself, the mechanics of the CDS. Contracts conform to ISDA specifications, the Derivatives Association. Each contract specifies a notional amount because, well, we need to protect ourselves from what? Just say a bond. Well, how much? 10 million, 100 million, $1 billion? The total amount of CDS notional can exceed the amount of debt outstanding. So a company can have $1 billion of debt outstanding. But CDSs against it, the notionals might add up to several $1 billion based on $1 billion. It's much the same with if you look at options on some stocks, that the amount of options outstanding, if they were all settled in terms of stock, if they were all settled, there wouldn't be enough stock to deliver given the number of options. So most derivatives are usually closed out for a profit or loss as opposed to taking delivery of any underlying. CDS buyer need not be a debt holder. So I don't actually have to hold a bond to protect myself against a downgrade in the credit risk. I can speculate that might happen. However, let's keep one thing in mind. This is not the same as going short a futures contract on oil, where you simply just go short and hope for the price to drop. If I'm going short on a credit downgrade, I got to pay the other side the premium leg while I'm waiting for it to happen. So I got to pay for the right to play. I just don't get to see what happens. I got to pay. And of course, as I'm paying those quarterly payments, those quarterly interest payments to the other side, well, we call them premiums. You don't call them interest payments. But as I'm paying those quarterly premiums, if my event doesn't happen, it's not the same as just saying, well, I bet on oil going down. It never went down. It didn't go up, but I didn't make any money. No, I still lose because I got to pay rent just to sit in that house. Credit default swaps have an expiration, much like any derivative contract. They all have an expiration. We don't really need to say CDS has an expiration date. Take that out and put the word derivative in there. All derivative contracts have an expiration date. Since a CDS is a derivative contract, it is no different. Anywhere from 1 to 10 years, 5 years being the most common. the buyer pays a periodic premium to the seller. And it's this periodic premium we mentioned before called the premium leg, referred to as the CDS spread, which is a return over LIBOR. That's what a spread is, right? A credit spread. But CDS rates, these the rates that the buyer pays to the seller, are now standardized, with the most common being 1% and 5%. So if the CDS is on an investment grade company or an index, it's standardized at 1%. If it's on a high yield company or an index, it's standardized at 5%. Here's the second part. Here's what introduces a little bit of complication now. To correct for the standardized rate being too high or too low, an upfront payment or premium is required. So when you could set the premium to whatever the credit spread is, no upfront payment would be required. Let's say it was 250 basis points. But now it's either 1% or 5%. So if it were 1%, that's too low. If it were 5%, that's too high. So one side must pay the other side the difference, the present value of the difference between the credit spread and the standard rate. So the credit spread of what it should be, and the standard rate based on what's specified in the contract, what it will be. The difference between those two, we take the present value, and that becomes the upfront payment. We'll see an easy way to calculate that later on, but just be aware that because of the standardization now, you can't customize to the exact credit spread because we're taking a 1% or a 5%. Might be too high, might be too low. Somebody owes somebody else something at contract inception. All right, so let's just clarify that last point with an example. Let's say that the buyer of the CDS pays the seller the 1%. That's the premium leg. That's the fixed rate on the premium leg. Let's make sure we have the language, right? That's the fixed rate on the premium leg. What if the spread should be higher? Then the buyer makes an upfront payment to the seller, because the seller is only getting compensated 1% for something that is worth 250 basis points. So he's only getting paid for the risk of 100 basis points when it should be 250. The buyer should compensate for the difference. What if the spread should be lower? What if it isn't 100 basis points but only 50? Well, the buyer is overpaying for something, so the seller makes an upfront payment to the buyer. So that's just how it's worked out. Keep in mind now, this is an important one, that the seller, the buyer has to pay this premium and perhaps an upfront payment. But that doesn't mean the seller doesn't have to pay something. We always sort of think that the CDS, the seller receives money and only pays out on default. But if the fixed rate is greater than what the spread should be, the seller will have to make an upfront payment as well. Now, for the buyer, the value of the CDS to the buyer increases if the reference entity's credit quality drops. That's why we say that the buyer is short, because the underlying is the reference entity's credit quality, this intangible thing we call a credit quality. We can't deliver credit quality, right? The seller, for the seller, the value of the CDS to the seller increases if the reference entity credit quality improves. Now, for the seller, the credit quality doesn't have to improve. It just does not have to degrade for the seller to win on this one. Well, and of course, not default. And even if the credit quality degrades, it may push the value of the CDS into negative territory for the seller, but unless a default event does occur, the seller will still be okay. So the long seller, when I say the long seller, the seller who's in it right to expiration, does a 5-year CDS and intends to hold it right to year 5, can make a long bet on that, saying they're not going to default, whether their credit quality improves, stays the same, or deteriorates. However, a short-term or a short seller, I shouldn't use the word short, a short-term seller, one who says, well, you know what, I think there's some fear that there's going to be some more credit downgrades for a particular company. I think it goes the other way around. The seller might be betting that the market is wrong on the credit quality deteriorating and is just going to hold a CDS until proven right. All right, let's talk about this default, which is a credit event. And there are three general types of credit events. Number one, bankruptcy. The actual filing. Even though a company goes into bankruptcy, they can still emerge from bankruptcy, just reorganized. The filing of the bankruptcy is the credit event. So we don't actually wait to see if a company is liquidated and it's over. Just the filing. Again, important point, may not lead to liquidation. So there might be some strategy in there for a seller to continue to hold a CDS, or even for a buyer to continue to hold a CDS in to bankruptcy if there's an exit in sight. A failure to pay scheduled interest or principal on any outstanding, keep in mind, any outstanding obligation. Cross default matters here, right? And restructuring, a change in seniority, change in the currency of payment, or a reduction of principal or coupon. So a reorganization of the debt itself. Perhaps a senior debt is being moved over into junior, and more senior is added in a restructuring. Or there's a change in the currency of payment. They're all considered restructurings. Must be involuntary. Any of this restructuring must be involuntary. In other words, it's forced on the borrower. Not considered a credit event in the U.S. A restructuring is not considered a credit event. Keep in mind, see, you may think, but why not, right? Well, it's forced on the borrower. It must be involuntary. Well, that makes a lot of sense. First of all, it's forced on the borrower. So if the lenders are forcing the borrower into a position where they're more likely to be repaid, but the lenders have plenty of insurance against default, then they don't care. As far as the lender is concerned, it doesn't matter. They're protected. So they can force an issuer into a position, say, look, you're going to have to reduce your principal. Let's everybody take a haircut. Let's all take 40% or 50% or 60%. They may not be as aggressive as they want to be and say, look, let's just do a 20% haircut or a 30%. No, go 50 or 60. Really give the company a chance for survival. Because, well, somebody else has insurance on it, right? Somebody else has to pay up based on their decisions. So for the U.S., they're saying, well, you know what? That can be gamed, so a restructuring in the U.S. doesn't qualify. A 15-member group within the ISDA determines if a credit event occurs, because it's hard to define exactly what a credit event is sometimes. So there's a 15-member group. It's called the Determinations Committee. It's made up of 10 CDS dealer banks, because they got money in the game, they care, and 5 end users to give you some sort of outside perspective on it. You need 12 votes. It's called a supermajority to be able to declare something as a credit event. You need 12 of these 15 to agree on it. Beyond a credit event, there is something called a succession event, which doesn't necessarily lead to a default and a payoff, but it does lead to a decision that needs to be made. A succession event is a change in the corporate structure of the reference entity, whether a merger, a divestiture, a spin-off, in which responsibility for the debt in question becomes unclear. If an event occurs, the CDS contract, an event meaning a succession event, not a default event or a credit event, a succession event. If an event occurs, the CDS contract is modified to reflect the new obliger for the original debt, may even be split up among multiple entities. So, think of this as I'm holding an option on a stock and there's a stock split. Well, it doesn't invalidate my option, just my option is modified to reflect the new number of shares at the new price. That's the same thing with a succession event. We're holding a CDS contract, there's a succession event. It's just modified to reflect that, hey, we said ABC Company was the reference entity. It's actually XYZ, or it's XYZ along with LMNOP, because they've now split off into 2 companies. One has 60%, the other has 40%. It could be something like that. So it just modifies who the reference entity is and may modify what the reference obligation is at that point. Settlement protocols. Once an event is declared, both parties have the right but not an obligation to settle. Now that sounds odd, doesn't it? They both have the right but not the obligation. As far as we know in derivatives, the seller is obligated to perform. When we talk about options, the call buyers or the buyers of calls and puts have a right, but the sellers have an obligation. In futures contracts, both parties are obligated. Here, both have the right to settle. And this comes with standardization. And with standardization, you have CDS dealers. So let's say that I am in a position where after an event, I want to be done with it. I can simply just take an offsetting position. The other side can wait it out. Either side can wait it out. They don't have to. They have the right to wait right until maturity. And if they're in a lost position at that point, well, they still would have to pay. They still have the obligation to honor the contract, but they don't have an obligation to end their side of the contract, because if I want out, I can just take an offsetting position with a CDS dealer and I'm done with it. Settlement, usually within 30 days after the event. Settlement can be done in two ways: physical settlement or cash settlement. For single name CDS, physical settlement is the more popular one. The holder, whoever holds the bond, sells the bond to the CDS seller at par. So let's say that you're the bond holder and you bought CDS, a credit default swap on that bond, and I'm the seller of that CDS. And there's a default event and you want to be made whole. I would say, well, you give me the bond and I'll give you the full face value of the bond. I'll give you par. And that's how it will go. And then I have the choice at that point saying, you know what, you're wrong. I'm going to hold on to this bond till maturity and everything will be just fine. Or I may think that after a reorganization or after emerging from bankruptcy, that the cheapest to deliver price on the bond is actually going to be significantly higher. So I can hold on to it. I don't actually have to, take the loss and settle out. I do have to give you the full par value of the bond, but I can accept the bond and keep going. Cash settlement, the seller pays the holder for losses, and that's it. Some words that we should know: a payout ratio is 1 minus the recovery rate. The recovery rate is the rate we get when we calculate what the cheapest to deliver obligation is. The payment amount is the payout ratio, whatever this is. So let's say that the recovery rate we find is 30% of par. The payout ratio is now 70%. The payout amount is 70% times whatever the notional amount of the CDS is. Not the amount of the bond. The bond offering, the total bond outstanding could be 100 million, but the notional on the CDS might only be 3 million of that. It would be 70% of the 3 million. Recovery may occur much later than the payoff to the CDS. This payout ratio and this recovery rate is set soon after the default event, within 30 days of the default event. But bankruptcy may take 3, 4, 5 months to settle out, so that the recovery, the value of the bonds, may occur much later than the payoff, which brings in the idea of, well, who is somebody willing to wait? Maybe the holder takes the cash but doesn't sell the bond and says, well, I'll take the cash, I'll take my payout amount, 70% of 3 million, I'll take my 2.1 million, but I'll continue to hold this because I think it might recover a little bit. So it brings in that ability to do that. So how do we figure out what the cheapest to deliver is? There are two ways. Either a polling of different CDS dealers for the value of the debt, or an auction. Major banks and dealers submit bids and offers for the cheapest to deliver defaulted debt, identifies the market's expectations for the recovery rate, and the CDS parties agree to accept the outcome of the auction. Actual recovery may be quite different. So let's just walk through a small example of that and make sure we got that straight. Let's say a company enters bankruptcy. It had senior bonds, had A and B, and right after bankruptcy, A is trading at 30% of par, B is trading at 40% of par. These are really low numbers, but hey, it just filed for bankruptcy, so there's a belief that there's not going to be a lot there, right? A trades at 30%, B trades at 40%. We have two investors, Investor X and Investor Y. Investor X owns $10 million of bond A and $10 million of CDS protection on A. Investor Y owns $10 million of bond B and $10 million of CDS protection. So both X and Y are protected on their bonds, and they own A and B respectively. The recovery rate is set by the cheapest to deliver. So we look at one is 30%, one is 40%. A is the cheapest to deliver. That's bond A. That's 30%. That becomes the recovery rate for both bonds, 30%. So investor X will receive $7 million because he's got $10 million of CDS protection. The recovery rate is 30%. The seller makes good on the difference, receives $7 million, sells or holds the bond for $3 million. You see, they don't have to sell the bond at that point. They're exercising their right under the CDS contract to be paid out. They're going to be paid out. They receive their $7 million. But there's nothing there that says they actually have to sell that bond if it's cash settled. So for investor X, they have no preferences to settlement. Whether it is cash settled or physically settled, they don't care. So if I were the seller and I were paying this out, I'm indifferent between paying the person cash or saying, here's your cash, here's $10 million instead, give me the bond. I'm indifferent between that. Investor Y. Investor Y's bonds are trading at 40%, but the cheapest to deliver is set at 30%. So Investor Y gets a bump, doesn't he? Receives $7 million, sells or holds the bond for $4 million, prefers a cash settlement. But as for the other side of the contract, they prefer physical settlement because they want that bond. Hey, I'll give you 10 and I'll sell the bond for 4, thereby minimizing my loss to 6. So how do we settle this off? Well, let's answer that question about how we don't arrive at problems where one side says, give me the cash, and the other side says, no, give me the bond. They don't really have that choice. I shouldn't say they don't have that choice. They have that choice before they know what the price is. So I'm going to go a little further on the credit auction because there may be questions. This screen is just an added extra. It's not in the video notes at all. It's nothing you need to know. It's just if you're curious. The credit event auction actually started in 2005, and the reason it started is because physical settlement works when you hold the bonds. If you bought a CDS and you hold the bonds, you can physically deliver. But, as we've said earlier, the amount of notional in CDS far exceeds the value of all of the bonds out there, so physical settlement simply cannot be done for everyone. It simply can't. So the credit auction was introduced, and here's how it works. It basically sets a price for all those that choose to cash settle. So buyers and sellers must submit an adherence letter to the ISDA selecting this option. So if there's a credit event, buyers and sellers who choose to cash settle must submit a letter saying we'll cash settle. So they have to choose before the auction. Before any auction, they got to choose that. Now here's what happens. A request is then sent out for physical settlement. All those holding the bonds saying, here's the bonds. Dealers will then place orders for that debt, and the recovery amount or the recovery rate is set at the market midpoint. So you'll have a range of bids for the debt, and they take the midpoint in the market. There you go. That becomes the price for all those choosing cash settlement. So you must choose cash settlement before the auction, and you must agree to abide by whatever price comes out, you agree to abide by. And then those who don't want a cash settlement will then submit their bonds for physical settlement, for physical delivery, and the dealers will place the order for that debt. Once a price is arrived at, then that becomes the price for clearing all the CDSs. All right, let's look at CDS index products now. All cash settled, by the way, because, well, as we know from equities, you can't deliver an index. Index products, we'll just do a brief introduction to index products, introduce a few, and then we'll go into settlement protocol on index products. Classified by region and credit quality. North America, Europe being the two most popular ones. So the more common ones, which are set up by Markit, M-A-R-K-I-T. CDX is the ticker for North America, iTraxx for Europe. And by credit quality, you can have investment grade and high yield. So for the investment grade categories, there's IG, makes sense, right? Investment grade. And for the iTraxx, it's called Main. So CDXIG represents North America investment grade, and iTraxx Main is European investment grade. 125 entities in each. So there's 125 in the CDX, 125 in iTraxx. There's also CDX HY, HY meaning high yield, and the iTraxx crossover. This is for high yield. I didn't make a note here. Investment grade is quoted in spreads. High yield is quoted in prices. For the CDX high yield, 100 components. For the iTraxx crossover, 50 components. Both use standardized coupons and are equally weighted. That's a big thing. Equally weighted. Settlement is thus 1/125th of the notional. So let's say that you buy $100 million of credit default of CDS insurance or CDS protection on the CDX IG. And one of the entities in there defaults. It's only 1/125th of the index. So if you have, let's make it a nice round number. Let's say you bought 125 million of CDS protection on the CDX IG, and one of the components defaults. That's only 1 million exposure to that. You only have 1 million exposure. So the notional on each component is 1/125th of whatever amount of insurance that you bought. Sorry, I keep saying insurance. I really want to say protection. And while I've been making that slip, let me explain why we should be clear of the difference between insurance and protection. While technically I'm buying insurance, it is not an insurance product. It is still a financial product. So we really want to try to get used to saying the word protection instead of insurance, because in the industry, the word insurance means something very specific. In just casual conversation, say, oh yeah, I bought insurance against that. Everyone kind of knows what that means, but we want to try to strive to be as precise as possible. When I say the word insurance, I'm technically saying the wrong thing, just so that you get that. But if I do say the word insurance throughout this and I don't catch myself, understand that I don't mean it's an insurance product. I just mean the essence of what's going on is insurance against something without it being an insurance contract. All right. So settlement is thus 1/125th of the notional. When an entity defaults, it is removed from the index and settled as a single name CDS. The index then moves forward with a smaller notional. And these are reset every 6 months. So you may have 5-year CDS protection on the CDX IG. So there may be a particular series that you have that protection on. 6 months from now, this CDX IG may be the same 125 components, but it may be different. 2 or 3 or 4 or 5 may be different. And so CDS drawn on that one would represent different entities. Yours would still stay with the original 125 for as long as you hold your CDS, but it's reset every 6 months. All right, well, why do we want CDS index products? Typically used to protect against or take positions on the credit risk of sectors. Protect against what? Well, you might have bond portfolios that are similar to the index, and maybe because of the existence of a CDS index, you're more likely to develop a bond portfolio that tracks that index very closely so that you can use it to buy your protection. So let's take an example and let's see what happens with this whole index thing. Let's say we sell $500 million of protection on the CDX IG, the investment grade CDX index. There's 125 components in there, right? We're a seller of this, so we're going to get paid a premium on this, 1%. 1% of the notional. Our notional is 500 million, right? But in the index, we like the idea of the index, but there's one little fella in there, component A, that we're not too keen on. So we're going to buy, at the same time, $3 million of protection on component A, so that we're covered on that one. That's a single name CDS. So we sold 500 million of protection on the IG, on the investment grade, because we think that, well, that's a good place to be credit-wise right now, except this company right here. So we're long the credit quality of the index, but we're short the credit quality of one component. A defaults. I told you. That's why I did this, right? I told you it would happen. There it is. A defaults. The investor is long 1/125th times 500 million, which is 4 million per component now. We are long because we sold 500 million. Remember, when we sell, we're long the credit quality. We're long 4 million. And when we buy protection, we are inherently short the credit quality. We're short 3 million. So we didn't hedge out perfectly. If we were very concerned about A, we would have bought 4 million, right? We would have known that. We're smart enough to know that you divide this by 125, each one is worth 4. We have hedged 75% of our exposure to A, in other words. Hedged 75%. Our net exposure is long. We're long 1 million. So if there's a default, if the recovery rate is 0%, we pay the buyer. The seller then pays the buyer. The remaining notional now that that A is defaulted, remember A made up 4 million of it, of the 500 million. The remaining notional on the CDXIG is 496. My index CDS continues to go on. Just because component A is defaulted doesn't invalidate the index CDX. The index CDX goes on. I had 500 million to begin with. Now I only have 496 because one of the components are gone. And each component is now 1 over 124. We can see that each component is still $4 million. Okay, so valuation and pricing of CDS. And here's the deal. We don't really have to get involved in all of the details of it. It's to value and price out a CDS. We're going to see that there's an upfront payment involved when a CDS is open. So let's talk about that first. Let's get that out of the way. To get to the value of what that upfront payment would be, we need to know what the spread on the CDS is going to be. We need to know what the spread is. To know what the spread is, we need a couple of things. We're going to need to know the probability of survival, and by default, of course, the probability of default. We're going to need to know the loss given default. We're going to need to know all of those. So I'm going to show you how we get to those, but we don't actually need to calculate anything more past that. We just got to show you how these things are calculated roughly, but we're not going to actually go through a problem, okay? It's not required at this level, just so that you have an understanding of what's going on behind the curtain, right? So you'll recall that the underlying of a credit default swap is credit, which does not trade. A company's credit does not trade. It's embedded as part of the bond itself. It exists implicitly within the bond. So we have to figure out, well, what would be the spread? What is of that bond, of the yield on that bond, how much of it is associated with that credit? And to do that, we got to get a probability of default. To get there, we have to introduce something called the hazard rate. And a hazard rate, while it sounds complicated and complex, it's like, oh, not another formula. It's actually quite simple. It's a conditional probability. It's the probability that an event will occur, given that it has not already occurred, and a hazard rate is such that once the event occurs, it cannot happen again. That's the end of the line. So if there's a default, that's it. So if we're drawing out a tree, for instance, let's start here, and we have our probability of default is 2%. Our probability of survival is 98%, getting to the first payment. If we have a probability of default, that's the end of that branch. From there, you could just draw a straight line right to the end. It's done. It's over. Then you have probability of survival is 98%, and let's say that this is a 2-year annual 5% bond. You'll get the $50 payment. And then for the next payment, there's another probability of default on probability of survival. And the probability of default does not have to be the same from period to period to period. It could be constant hazard rate. It could be upward sloping. In other words, the further out we go, the higher the probability of default, because from where we're standing today, on a 1-year bond, there's only 1 year for things to go wrong, but on a 10-year bond, there's more things that can go wrong within 10 years. So maybe going out 5, 6, 7 years, there's a higher probability of default. Another argument might be, no. The longer the company survives, the less likely it is to default, simply because it's getting stronger. its balance sheet is getting bigger, it's generating cash, it's becoming a much more stable company, so the probability of default would decrease the further out we go. The longer it survives, the lower the probability of default. However you want to model it, be aware that there's different ways to model it. We're not actually going to do it, but look what happens here. And let's say our recovery rate is 40%. We're going to do a 2-year annual 5% bond. And this is just a quick way of how we would get to the probability of default. 98% survival, 2% default. You could just run right to the end and say we have default at a probability of 2%. From this payment to the next payment, 96% chance of survival, 4% probability of default. So we could just put a probability of default of 0.98 times 0.04. Remember, conditional probability. This is the probability of defaulting given that we haven't defaulted. There can never be a probability of defaulting given that we have defaulted. That's the whole idea behind hazard rates, is there's only one direction. And this, of course, is probability of survival. This would be in the end of the tree. If we had another payment here, there'd be probability of survival, probability of default. That would be the end of that. So you can see that to draw out a 10-year tree, for instance, there'd really only be one pathway for survival. Everything else would be default. So if we get the 50, and if we get the 50, this original 50 plus the 1,050, in other words, we're getting 1,100, that's what this bond would imply. What's the probability? 0.98 times 0.96, 94.08. There's our probability of survival. Everything else must be the probability of default. We don't have to calculate the probability of every single branch. We just have to know what is all of the probabilities of survival over how many years that we have. Multiply those all together, there we go. The difference is probability of default. So here we have the probability of default of 0.98 times 0.04, which is 3.92. Here it's just 2%. If you add these two together, you get 5.92. And of course, it's 5.92 plus 94 is 100. So that's how we would get our probability of default. Let's talk about this recovery rate, 40%. What this is saying is that at any given time that it defaults, what is the recovery rate of all of the remaining interest payments, all of the remaining coupon payments plus the principal? Because you're giving that up, right? So let's go with the first one. It defaults right away. Well, we have a recovery rate of 40%, so we'll get 40% of the 50 back, which is 20, and we'll get 40% of the 1,050, which is 420. So we will recover 440. Here we get the full 50, but only 40% of the 1,050. So those are our recovery rates. We're going to use this on the next screen when we calculate our loss given default. To get to the spread, we need to know what spread is associated with this credit default. And I know I've said earlier we have standardized spreads of 1% and 5%. But to figure out what the value of the upfront payment is, we have to know, well, what would be the real spread first of all? And then we'll subtract the spread that is fixed, the fixed rate, or see what difference that we have there. So we have to get to the spread. To get to that, we need the probability of default and the loss given default. This is basically how the probability of default is calculated. So let's look at our loss given default. For this branch, this branching of the tree of survival only, loss given default is not applicable because there is no loss. It's loss given default. So we only want to follow the branches where there's default. Here's the first one. What is our loss given default? Well, we recover the 50, so we're good there. We recover 420 of the 1,050, so we lose 630. Here we lose 30 on the 50, and we lose 630 on the 1,050, so we lose 660 altogether because that's our recovery. And our expected loss, once we have our loss given default, we can calculate our expected loss. 3.92% of 630 is 24.696. 2% of 660 is 1320. And there we go. Our expected loss is 37.869. So the probability of default times the loss given default equals our expected loss, and you simply just sum across all the branches that are defaulting, and you will get your expected loss. This is a long process, typically done in a spreadsheet. I can show you how, if there's enough demand in the comment boxes below this video saying, yeah, put a video up to show how that's actually done in a spreadsheet. I'll show you how, but here's the deal. You don't have to know it. You just have to have a good idea of the process that's involved. Step number one, what are we doing? We're trying to figure out what the credit spread should be if there were no fixed rate on the CDS. We know it's either 1% or 5%, one of those two. But if that wasn't around, what would it be? This is the process that we go through to calculate that. To show you how easy it is to get the probability of default, though, let's take a 10-year with equal hazard rate of 2%. The probability of default is 1 minus 0.98 to the 10, because at each branch you have 0.98, and of course you have a default. The next branch you have 0.98, and you have a default. That's the end of that branch. That's the end of that branch. The next one here, it branches out again. You have 0.98. This is the end of that branch. You have default. So you can see there's only one pathway that everything could take where you survive. So 0.98 to the 10 is our probability of survival. Probability of default is 1 minus that, 18.3. So there's the first amount. Now we just have to have the loss given default for each one of these branches. The probability of default here times the loss. Probability times the loss. Probability times the loss. Sum them up and we will have our expected loss. From there, we can move on to calculate what the spread actually would be. But again, we're not actually going to do that. You just need to know, okay, that's the general direction we go. I see what's happening in the background. Great. All right, let's make sure we understand what we've just done here. Assume that a company's hazard rate is a constant 8% per year or 2% per quarter. That's a pretty big hazard rate, by the way. An investor sells 5-year CDS protection on the company with the premiums paid quarterly over the next 5 years. What is the probability of survival for the first quarter? Well, our first quarter, we're told we have 2% per quarter, so we have a default of 0.02. Our probability of survival would be 0.98, or 98%. That was fairly straightforward. What is the conditional probability of survival for the second quarter? Well, you can't follow this branch because this branch is done. So there's our first branch, 0.02, 0.98. You must follow this branch. And of course it's constant per quarter, so we have 0.02 and 0.98. So it's saying what is the conditional probability? You'll recall the conditional probability is just the probability associated with this branch, 98%. It's not asking what is the probability of survival for the first 2 quarters. It's just saying what is the conditional probability of survival for the second quarter. In fact, the conditional probability of survival for any quarter is 98% because we have a constant hazard rate of 2% per quarter. So it will always be 98. Number 3, what is the probability of survival through the second quarter? Well, there we go. That's 0.98 squared, which is 96.04. Be careful about something like that. I doubt if you'd get questions like this on the exam. Typically, the questions are pretty much around a particular story, and there are a bunch of questions around that particular story. That there'd be a question like this, I don't know. I don't think so. But if there is, be aware of the wording. This is saying conditional probability of a single event, of something, of one thing happening, which is 0.98. This is saying what's the probability of both events happening, survival in the first and survival in the second, survival through the first quarter. All right, let's assume now that we have our credit spread. Again, we don't have to actually calculate it. You understand how we were walking towards it, but let's say that we actually have it now. Now we're ready to figure out how to get to the value of that upfront payment. Recall that there are 2 legs to a CDS. There was the protection leg and the premium leg. And the protection leg, this is what the seller pays the buyer if there's a default. The premium leg is what the buyer pays the seller. The CDS spread is calculated by equating the present value of the protection leg. This is why we need to know the expected loss. And we equate it equal to the present value of the premium leg. And whatever that spread is, will make these 2 sides, these 2 legs equal. So in other words, what we're saying is here is the spread will equate both sides. So on day 1, both sides are equal. They start out equal. Now that may not stay that way. No derivative contract stays that way, but they're equal on day 1. But here's the thing. We don't use that spread anymore.
So we can't really equate these two together. So you still have to do this. You still have got to do this to find what the true credit spread should be. But since we use standardized rates, these two will not be equal anymore. The upfront payment will be equal to the present value of the protection leg minus the present value of the premium leg with the standardized rate. So there'll be some real rate, let's say it's 250 basis points. And we're using a 1% rate down here as the fixed leg. Well, the present value of the protection leg minus the present value of the premium leg will be positive, because this will be much bigger than this because it's only 1%. If we actually could use 250 basis points, they would be equal. So if the upfront payment is greater than 0, if after we calculate this it's greater than 0, the buyer pays the seller. Who would be paying in this situation? The seller is offering something to the buyer that's worth 250 basis points. But the buyer is only compensating the seller for 100 basis points of it over the life of the CDS. So over the life of the CDS, the buyer is compensating the seller for 100 basis points. So on day one, the buyer has to compensate the seller for the present value of the 150 basis points. If it's less than 0, let's say instead of 50 basis points, the true amount was 50 basis points, means the buyer is compensating the seller 100 basis points for something that only should cost 50. So in this situation, the seller would have to pay the buyer the difference. If it's less than 0, seller pays the buyer. CFA does not require the calculation of any of these present value amounts. You just have to understand the logic of what's going on here. What is this upfront payment about? It's because we use standardized rates instead of the real spread that would make these two equal. And because we use 1% or 5%, somebody owes somebody else money on day one. We don't just say, oh, well, let's just live with 1%. No, if it was 250 basis points, somebody somewhere wants to be paid for the 250 basis points, even though I'm only going to get paid for 100 basis points under the term of the contract. The upfront payment takes care of the rest. That's what you need to know. Okay, I had mentioned a little earlier about the path of the hazard rate, whether it would be a constant hazard rate over time and increasing or decreasing. Well, let's have a look at what they mean. Let's just be a little bit more clear. Let's say that we're looking at a company's a specific 10-year obligation. So here is a 10-year obligation, and that we have a probability of default or a hazard rate that if we plot out the spread over time, it looks like this. So that we have a smaller spread at the earlier period of time, increasing into a wider spread later on if we were looking at each and every period of time. So the spread at any given point is roughly equal to the probability of default times the loss given default percentage. We saw this in the last reading, the term structure of credit spreads, but this is for a particular company on a particular obligation, so we call it the credit curve or the company's credit curve. So what does it mean if it's upward sloping, flatter, downward sloping? An upward sloping credit curve means there's a greater likelihood of default in later years. So there'll be a bigger spread associated with that. A downward sloping curve means there's a greater likelihood of default in earlier years. And a flat one means there's a constant hazard rate. So if you were buying CDS protection and you felt that there was a downward sloping curve, you might say, well, you know what, it's a 10-year obligation, but I don't need 10-year protection. I might need only 4-year protection, because you might have a threshold above which it's unacceptable to accept that risk, so you might just buy CDS to cover a certain percentage. If you have this obligation, you might say, you know what, for the first 4 or 5 years I can hold without protection. After that, I'm going to put protection on onto the bond. And this constant hazard rate, you might have an opinion that says, well, I don't think it's constant, it's either upward sloping or downward sloping. Well, that gives what we're going to see in learning objectives D and E. That sets up a sort of almost a pairs trade on that one, a long short trade. All right, let's get back to this upfront premium we talked about earlier. You recall it was the present value of the protection leg minus the present value of the premium leg. And this is the premium leg with fixed rate, 1% or 5%. And remember, if the spread equaled the rate, if instead of using a fixed rate here, we actually use the spread, the upfront payment would equal 0, because we get to the spread by equating these two legs equal. So the present value of the protection minus the present value of the premium would be 0. There'd be no upfront payment. So the upfront payment, we can think of the upfront payment as opposed to, instead of being the present value of the protection leg minus the present value of the premium leg, is really the present value of the spread, because that would equal the present value of the protection leg if we use the spread. So let's just put that in there. It would be the present value of the spread minus the present value of the rate. Well, spread minus rate with PV on the outside, let's put that together. So it's spread minus rate, and instead of putting present value in, let's get rid of that and just multiply by duration. So the upfront payment can be calculated by the credit spread minus the fixed coupon times duration. If you rearrange it, we can get to the credit spread is equal to the upfront, and all we're doing right here, upfront payment, if you divide through by duration, you'll have upfront payment over duration equals credit spread minus fixed rate. Add fixed rate to both sides, here's what you get. Credit spread equals the upfront payment over duration times the fixed coupon. And the price of the CDS per 100 of par is 100 minus the upfront payment percentage. So this is easier to work with once we know what the real spread is. Again, we don't actually have to calculate the spread. You just have to know that if you equate these two, again, it's a longer process than just saying equate these two and solve for the spread. It requires 3 steps to get there. I'm not going to show you that. You don't need to know it. It's behind the scenes. But just keep in mind, upfront payment, if you just take the spread minus the fixed coupon, multiply it by the duration, you'll get the upfront payment. All right, let's do a couple of examples just to make sure that we have this down right. Let's take a high-yield company. What do we know about a high-yield company? Remember, we have 2 fixed rates, 1% and 5%. High yield, we're looking at 5% here. 10-year credit spread is 600 basis points. CDS duration is 8 years. What is the upfront premium on something like this? Well, we know it's our credit spread minus our fixed coupon times our duration. That's simple enough, right? What is our credit spread? Our credit spread is 600 basis points. What is our fixed coupon? It's 500 basis points. And what is our duration? 8 years. What do we get? We're going to get 100 basis points times 8, or 8%. And that's 8% of the notional. So if you're looking for $20 million notional, 8% is $1.6 million. Number 2, sell 5-year protection. Investment grade company. So you're selling 5-year protection on an investment grade company. That is a 1% fixed rate. The upfront premium is 2% paid to the buyer. So the buyer is not paying the seller is paying the buyer. It is going in the opposite way of the premium, which means it's going to have a sign change. If the buyer were paying the seller, that's positive. But for the seller to pay the buyer, remember what happens. The present value of the protection leg minus the present value of the premium leg must have been negative, which means the seller pays the buyer. So the upfront premium is negative 2%. CDS duration is 4 years. What is the credit spread on this? And we can see credit spread in here. We know the upfront premium, we know the fixed coupon, we know the duration. We could put it into this formula, do some rearranging and solve for credit spread, or we could just rearrange and solve for credit spread, right? So it's going to equal negative 0.02, which is the premium. It's a negative premium because it's the seller now sending it to the buyer, divided by duration, which is 4 years. Plus our fixed coupon, which is 100 basis points, or 0.01. And if you solve for this, you will get 50 basis points. So what this is saying is that the fixed coupon is 100 basis points. If the credit spread is 50 basis points, then we're looking at 50 basis points in the end to value. The value of the upfront premium will be based on 50 basis point difference. The price of the CDS per 100 is 100 minus the upfront premium, which is 100 minus, what's the upfront premium? Negative 2. 100 minus negative 2 is 102%. 102%. Very straightforward. That's about as far as the CFA expects you to go to understand how you can take an observed upfront premium and
duration and a fixed coupon to calculate the credit spread, or to go the other way, if we have the credit spread and the fixed coupon duration, we can calculate the upfront premium. Okay, so let's look at, as we move away from the date of inception, how does the value of the CDS change? Well, the probability of default can change, the expected loss can change, the shape of the credit curve, they can all change over time. So as they change, the value of the CDS changes. The profit for the CDS buyer. Now remember, if you're a buyer of CDS, you're inherently short the credit quality, right? The profit for the CDS buyer is roughly equal to changes in spread in basis points times duration, and of course times the notional, right? The changes in spread in basis points times the duration will give us the percentage change in the CDS price. So let's just look at an example, see how that plays out. Buy $10 million of 5-year protection. CDS duration is 4 years. At T0, at time of inception, the credit spread was 500 basis points. At the time now, it is 800 basis points, so it's widened. So does that benefit the buyer? Well, we are buying protection. If the credit spread increases, the value of our bond drops. That's what we want to protect ourselves from. If the value of the bond drops, the CDS should increase because we're short credit quality, and credit quality has deteriorated by 300 basis points. Therefore, the buyer benefits. By how much does the buyer benefit by? Well, 300 basis points times the duration is 4. And times the notional, and what we're told the notional is 10 million. So if you multiply this out, we will get 1.2 million. 1.2 million. And the percentage price change is just the first two, is just this, which is 300 basis points times 4, or 12%. What's 12% of 10 million? 1.2. That's how easy it is. You didn't even have to do this. You could just look at that times the notional, 1.2 million. 1.2 million of 10 million is 12%. There we go. All right, let's look at some of the uses of CDS. The main function of CDS is to facilitate the transfer of credit risk. So we can see that our uses are going to be one of two, either to increase or decrease credit exposure. Decreasing credit exposure, debt holder buys CDS to hedge or reduce risk. A seller adds credit exposure, and typically CDS dealers are the main sellers of CDS. Rather than buying a bond, an investor can sell a CDS. If you buy a bond, you have credit risk and interest rate risk. Well, let's say you don't want interest rate risk, but you don't mind the credit risk. Well, don't even bother with the bond. Sell a CDS. You'll get credit risk only. Far less capital than buying the bond, lower transaction costs, and the CDS may actually be more liquid than the bond itself. Now, if you sell a CDS, if you buy a CDS without owning the underlying bond, you are said to be naked. That's a naked CDS, buying without exposure. Remember earlier we talked about settlement and why we use cash settlement versus physical settlement, and you would elect cash settlement if you have no bonds to deliver. If you have no bonds to deliver, well, you can't possibly do physical settlement. Another interesting use of the credit default swap is to turn a lower rated bond into a higher rated bond. Let's say that you're a fund and you can only invest in AA bonds. So I'm just going to put it over here that you can only invest in AA bonds. And let's say there's a company that has a BBB bond. And you have found that if you buy the BBB bond and you buy a credit default swap on the BBB bond, you'll still get a better return than if you bought a AA bond. But you can't buy the BBB bond. You're restricted from buying the BBB bond. So here's what you do. Is you buy the BBB bond, and then you buy CDS from a CDS dealer that has a AA rating, because now the CDS dealer is offering you full protection to the downside. So let's say here you're the fund. You will buy the bond and you will buy a CDS from this AA rated company, thereby making the bond rated AA, because of the CDS dealers from a bank or any other company that has a AA rating. You now have turned this bond into a AA bond.
So the fund doesn't, even though it only can invest in double A or higher, let's say, this is just an example, they can still shop other bonds and just get default CDS insurance against it to see if it's still worth it, if the return is still better than just buying double A. So what we just talked about on the last screen, long positions and short positions, we've got that covered. You can combine CDSs. You can be long in one CDS and short in another CDS. That's called a long-short trade, not to be confused with this. This is long or short positions in CDSs, which means you can either be a seller of CDS. Remember, if you're long, you're selling, or you could just be a buyer of CDS. You don't have to own the underlying. You could just be making a bet on the direction of the credit of the underlying of the company with the underlying obligation. This, what you're saying is that there's going to be a difference in credit risk among two different things. So let's say, for example, we know the CDXIG is our investment grade index, the CDXHY is our high yield index. So we might be long the CDXIG, which means we would sell CDS against this index, and we would be short CDXHY, we would buy CDS on this. So what we're saying by playing off the two together is saying, I don't know who's going up, who's going down, but I do know this, that the credit spreads between the two will widen, and that would be a winning trade if it did widen. You could buy a CDS of one maturity and sell a CDS of another maturity. So let's say that we have our original situation, which is the white curve over here, and you expect the curve to steepen. You expect in the near term, not much is going to change, but the long-term outlook for a particular company may change. So we would be long a short-term CDS. In other words, we would sell a short-term CDS because we don't expect too much downside there. And we would short a long-term CDS because we expect credit spreads to really widen. And if the curve steepens, then this trade pays off. So you can see that once you understand how the CDS works and how it pays off, you can combine them much as you can combine options on a trade. Long one option, short another option, etc. All right, one more learning objective to go, and this is kind of like the last learning objective we did. We're looking at the uses of CDS, but here in a very particular instance, we're looking at it, the use of the CDS to take advantage of valuation disparities. So let's have a look at what that means. The amount of yield on the reference entity's bond attributable to credit risk should be the same as the credit spread on the CDS. That makes sense. But differences can arise or can result from differences in opinions. Maybe the bond market has a different opinion and the CDS market isn't there yet. Different models used to arrive at those spreads. Different liquidity. Remember, the CDS market in many instances is probably more liquid than a particular bond offering, especially a small bond offering, and perhaps the price hasn't gotten to the point in the bond market or can't get there that makes that the credit spread on the bond converge to that on the CDS. Well, this sets up a strategy known as a basis trade, and the basis is that difference between the credit spreads on the two instruments. The bond market, let's look at an example here. The bond market has a bond which is implying a 5% risk premium. The CDS implies a 4% risk premium. So we have negative basis because the bond is 100 basis points greater than the credit spread. If the credit spread had more, we would have positive basis. So we've got negative basis. What do? How do we take advantage of this? Well, we don't know which is right. You don't know if the bond market's got it right and the CDS market is wrong, or if it's the other way around. But we do know this. One is clearly overvalued versus the other based on this spread. Well, if we have a bond that's implying 5% risk premium when it should be 4% risk premium, clearly the bond is undervalued because we're discounting it by a higher spread, right? Clearly the bond is overvalued, so let's buy the bond. But we might be wrong. That might not be the case, so let's go ahead and buy the CDS as well. So if you buy them both, when they converge, you will capture the 1% differential. Why do we have to buy the CDS? Because if you buy the bond, you're long credit quality. If you buy the CDS, you're short credit quality. We want to be long and short so that they converge. You get the 1% differential. That takes care of credit default swaps.
Don't hurt yourself on this chapter. You really don't have to know all of the details and all of the math behind this. That gets a far afield from what the CFA requires from you. And by the way, this also wraps up fixed income.